News just in, Wall Street is bracing for a potential stock sell-off. Analysts warn that the market's huge gains may be at risk. The stage is set in 2023, with the stock market exceeding expectations. The S&P 500, for instance, has seen a surge of 18%, inching closer to its all-time high. But amid the cheering and celebration, some analysts are sounding the alarm bells. There's a brewing concern about a potential sell-off and a bubble in the market. Marko Kolanovic from JP Morgan, for example, cautions about the high concentration of stocks in the S&P 500. He believes this indicates a bubble that could be threatened by headwinds in the macro environment. It's a bit like packing too many people in a boat. It may sail smoothly for a while, but a strong gust of wind could tip it over. Then we have Scott Wren from Wells Fargo expressing concerns about inflation. He believes there's a risk of inflation rebounding, which could negatively impact the market. Imagine having a balloon slowly inflating. It might be okay for a while, but inflate it too much, and it bursts. That's the risk we're facing with inflation. Adding to the chorus of concerns is the world's largest asset manager predicting roller coaster inflation. This could squeeze corporate margins, leading to a downward spiral for the market. Picture a roller coaster ride, except it's not fun and it's your money on the line. Lastly, David Rosenberg points to the Dow's recent winning streak and warns of a potential short-lived rally. He highlights that falling inflation, while cheered by markets, could lead to lower profits for businesses and weigh on stocks. It's a bit like winning a race but running so fast that you tire out and can't finish the marathon. As Wall Street anticipates a roller coaster ride ahead, investors are urged to stay vigilant. It's a bit like sailing on choppy waters. You need to keep your eyes on the horizon and be ready to adjust your course at a moment's notice. In a major shakeup, some of the world's biggest companies have announced significant layoffs this year. The wave of job losses in the tech world has been led by Meta, the parent company of Facebook, which has confirmed plans to lay off 4,000 technical roles across its various platforms, including Facebook, WhatsApp, Instagram, and Reality Labs. This isn't the first time Meta has made headlines for its downsizing efforts. Just last year, in November 2022, the social media giant cut around 11,000 jobs. It seems that the new year hasn't brought much change for the company's employment trends, but Meta isn't alone in this. Other technology heavyweights like Amazon, Google, Microsoft, and Salesforce have also announced significant layoffs. These companies, which have been the backbone of the tech industry, are now in the process of reducing their workforce, marking a significant shift in their operational strategies. So what's driving these layoffs? It seems that a combination of factors are at play. For one, the economic downturn has put immense pressure on companies to cut costs and streamline their operations. With uncertainty looming large, organizations are choosing to focus on areas of growth, even if it means parting ways with a significant portion of their workforce. Another reason could be the company's strategic shift towards more automated processes. With advancements in technology, many routine tasks can now be automated, reducing the need for human intervention. This shift, while beneficial for companies, unfortunately, means fewer job opportunities. But despite these challenges, it's crucial to remember that change often brings opportunity. As companies continue to evolve, new roles and skill sets will emerge, providing fresh avenues for employment. As companies continue to streamline their operations, the global workforce faces a challenging road ahead, but with resilience and adaptability, there's always hope for a brighter future. The stock market has shown a negative reaction to a slowdown in inflation and recent Fed meetings. Let's dive a little deeper into this. The Bureau of Labor Statistics recently released the latest Producer Price Index report. This report showed a slight increase in final demand, indicating a slowdown in inflation. Now, while this might seem like good news, certain sectors like the food industry continue to bear the brunt of inflation with higher prices. The stock market didn't take this news very well, with the Dow Jones, S&P 500, and Nasdaq all experiencing losses. The Federal Reserve's decision to raise interest rates during their December meeting added fuel to the fire, causing further decline in the market. This move was made to help control inflation, but it's clear that the market is still adjusting to the change. Looking forward, the Fed does have plans for more rate hikes in the coming year, 2024. However, they've also signaled a willingness to lower rates if inflation is successfully controlled. This leaves investors in a bit of a limbo, as they try to predict the Fed's next move and adjust their strategies accordingly. In these uncertain economic times, market volatility is the only certainty. Every upcoming economic report, from jobless claims to retail sales and consumer sentiment, could potentially impact market performance. And with so many variables at play, it's increasingly difficult for investors to navigate the market. This is where artificial intelligence comes into the picture. AI tools, such as QAI, are becoming invaluable resources for investors, helping them make sense of the market complexities and guiding their investment decisions. With a volatile market and uncertain economic times, investors look towards AI tools for guidance. As we wrap up today's news, let's take a moment to reflect on the major stories we've covered. Firstly, we dove into the possibility of a Wall Street stock sell-off. The year 2023 has seen stocks surpass expectations, with the S&P 500 up 18% and approaching an all-time high. But some analysts are voicing concerns about a potential sell-off and a market bubble, with potential threats from macroeconomic headwinds and inflation rebounding. The world's largest asset manager even predicts a roller coaster inflation ahead, which could squeeze corporate margins and impact the market negatively. Then, we moved on to the massive layoffs in some of the largest companies in the world. Facebook's parent company, Meta, plans to lay off 4,000 technical roles across its different platforms. This follows their previous cut of around 11,000 jobs. Other tech giants like Amazon, Google, and Microsoft have also announced significant layoffs. The economic downturn and efforts to regain control are cited as reasons for these cuts. Lastly, we discussed the market's reaction to inflation and the Federal Reserve's meetings. The latest Producer Price Index report showed a slight increase in final demand, indicating a slowdown in inflation. Still, certain industries continue to face higher prices. The Fed's decision to raise interest rates led to a market decline. However, they signal a willingness to lower rates if inflation is successfully controlled. The implications of these events on the economy are significant, and it's crucial to stay informed. Artificial intelligence tools like QAI can assist investors navigate these uncertain times, providing valuable insights and predictions. In these rapidly changing times, staying informed is more important than ever. Tune in for more updates and insights on AI News Today.